What if tomorrow all the money in the world was suddenly backed by gold again? Picture it. Every bill, every transaction, every bit of savings, tied to real gold locked away in vaults. But then, what about cryptocurrencies? Would they still matter in a world where gold takes the throne once more? Gold and crypto, so different, yet oddly similar. Both scarce, both resistant to inflation, but one is ancient and physical, the other digital and borderless. If the gold standard returned today, it could reshape everything. Would crypto fade into the shadows, or rise as the true alternative in a rigid, gold-bound economy? For over a century, many countries used a system where every bill or coin had a fixed value backed by gold. In other words, you could walk into a bank and exchange your money for a specific amount of gold. For example, if $1 was worth 1.5 grams of gold, you could hand over your bill and receive that gold in return. This gave money a solid foundation, something real behind its value. Governments couldn't just print more money whenever they wanted. They needed enough gold in their reserves. That was the rule. No more gold, no more money. Although the gold standard provided stability, it also limited countries' ability to manage economic crises. In times of war or recession, governments needed to spend more money than they had in gold. But under this system, they couldn't do so without breaking the rules. During the Great Depression and World War II, many countries began printing money without enough gold to back it. However, in 1971, President Nixon suspended the convertibility of the dollar into gold, and with that, the gold standard came to an end, paving the way for fiat money, money that no longer needs a physical backing. Now, cryptocurrencies, like Bitcoin, are decentralized digital currencies, meaning they don't rely on a central bank or government. They use a technology called blockchain, which ensures that all transactions are secure and transparent. One of their key features is scarcity. For example, there will only ever be 21 million Bitcoins. Additionally, transactions are fast and low cost, as they don't require intermediaries like banks. If the gold standard were to return, cryptocurrencies would have to adapt to a system where the value of money is backed by real gold. Cryptos, being decentralized and scarce, would still be an option for refuge, but they could face new government regulations that integrate them into the traditional financial system. Moreover, the fast and cheap transactions of cryptocurrencies might be limited by the rigidity of the gold standard. The return of the gold standard forced governments to be more responsible with their finances and cut down on excessive spending. However, it would also leave them with fewer tools to stimulate the economy during difficult times. In a world where cryptocurrencies exist, this would be an even greater challenge, as governments would have to compete with digital currencies they can't directly control. But what would happen to the banking system? The return of the gold standard would reduce banks' ability to create money through lending, since the amount of money in circulation would be limited by the gold available. Banks would become more conservative with their loans, and the cost of credit would likely rise. The economy would slow down, but it might also become more stable. At the same time, with the rise of cryptocurrencies and decentralized finance, DeFi, many people might choose to operate outside the traditional banking system, accelerating its transformation, or even its decline. If the gold standard were to return, Bitcoin could establish itself as a digital alternative to gold. Its scarcity, only 21 million will ever exist, decentralization, and resistance to censorship make it very similar to physical gold, but with technological advantages. In a system where fiat money is limited by gold reserves, many investors and citizens might turn to Bitcoin as a way to protect their wealth, especially in countries with unstable economies. Bitcoin could also serve as a refuge from state control, allowing people to move value without relying on banks or governments, giving it a key role in the balance between financial freedom and monetary control. If the world returned to the gold standard, countries with large gold reserves, like the United States, Russia, or China, would have a clear advantage. Their currencies would be stronger, and they would gain greater global economic power. Nations with stable economies and low debt would also benefit, as the new system would demand stricter fiscal discipline. On the other hand, countries with high debt, weak currencies, or limited access to gold could face serious challenges. They would struggle to raise funds, face devaluations, and risk economic crises. In this scenario, cryptocurrencies could offer an alternative escape for citizens in those countries, seeking protection from inflation or state control. Under the gold standard, interest rates would be closely tied to the amount of gold available. If a country has more gold reserves, it could offer lower interest rates because it would have more backing to issue money, which would increase confidence in its economy. Conversely, if gold reserves were limited, interest rates would rise to compensate for the lack of liquidity and ensure that the circulating money was backed. This could limit the monetary policies of central banks, which currently adjust interest rates based on economic needs. However, by relying on gold, the rates would be much more fixed and less adaptable to sudden changes in the global economy. Inflation would be more controlled. Since money would be backed by a limited amount of gold, Governments could not simply print money to cover deficits or increase spending, which would reduce the possibility of hyperinflation. The scarcity of money would act as a brake on inflation, but it could also cause problems if the supply of gold does not grow at the same rate as the economic needs of the population. However, this could lead to deflation if the economy grows faster than gold reserves, causing prices to fall, but it could also result in low wages and an economic recession. If countries were to adopt the gold standard again, financial markets would be characterized by greater price stability, but they would also present significant limitations in terms of flexibility. With currencies backed by a tangible asset like gold, investors might have more confidence in the stability of currencies, as the possibility of creating unlimited money would not exist. This would reduce the risks associated with hyperinflation and currency devaluation, attracting capital that seeks safety. However, this stability would come at the cost of rigidity. Markets would be less adaptable to rapid changes in the global economy. In the face of economic crises or international fluctuations, governments would have fewer tools to respond quickly. Since they would be tied to a fixed amount of gold, central banks would not be able to easily loosen monetary policy, which could create temporary instability in the markets as investors would react to the government's lack of capacity to deal with new crises. Regarding the investment market, the money supply would be drastically reduced. With gold as the limit for issuing currencies, financing options would become more restrictive, especially in sectors like technological innovation or projects that depend on fast and scalable investments. Interest rates would be higher due to greater competition for capital, reducing access to credit, primarily affecting emerging businesses, and limiting the expansion of certain sectors. Returning to the gold standard could therefore create a more conservative market, where investors focus on safer assets, but with less dynamism for areas that require heavy investment in a competitive and changing global environment. A hybrid system combining gold-backed currencies and cryptocurrencies could be an intriguing solution, balancing the best of both worlds. Gold would provide a solid, reliable foundation for currencies, ensuring stability and control, while cryptocurrencies would bring flexibility, advanced technology, and the ability to make fast, global transactions. This system would allow governments to maintain the necessary monetary control while offering citizens and businesses the ability to operate outside traditional systems, using cryptocurrencies for international transactions, savings, or investment. Would the return to the gold standard really work today? Or is it simply a reaction to the fear of inflation? Returning to the gold standard could offer stability, but in today's context, it may be better to maintain the current financial system, where people have the freedom to choose their methods of transaction, whether in fiat currencies, cryptocurrencies, or even gold. Flexibility is essential in a dynamic global economy, where governments and citizens need to adapt quickly to unexpected changes. The real challenge isn't imposing limitations, but ensuring proper fiscal responsibility. Governments should focus on maintaining efficient fiscal control, ensuring that money isn't printed excessively and avoiding uncontrolled inflation, without restricting payment and transaction options. A system that allows the choice of exchange mediums and focuses on responsible fiscal management could foster more stable and sustainable long-term economic growth.